Hi folks, quick example, hopefully it's quick, on how to deal with broken credit put spreads. By broken I mean credit put spreads that have fallen under pressure from capitulating prices like we've had in the NASDAQ. I'm going to share a specific example that I just discussed with somebody. So they are long PLTR via a credit put spread that is completely wrong right now. And it expires this week, so that's March 12th. I like the stock, by the way. And so the credit put spread looks like this. This is E-Trade, by the way. It's garbage. Don't go there. That's my gift to E-Trade for mistreating everyone. So here we go. 30, just so I can show both legs. This is the current trade. Clearly, it's close to full loss because it's now $5 because price has fallen so much below it and so little time, 3 days on the clock. Today is the 9th March. So in this case, there's nothing really to salvage. We waited too long to fix it. The hope is that it pops. It's not likely to pop through 32.50 because I'm looking at it's $24. I like the stock anywhere below 25 for an investment. If I own shares, I would sell covered calls all along. And so how I would handle this myself. I had a similar situation with US Steel last year where I was in a put spread like this, almost similar, and I had sold the $9 put and I owned an $8 protection put, and the stock collapsed to 4. So very similar distance. So what I did, they didn't assign me the shares. I had time on the clock. In this case, they don't have time on the clock. But my trade was complete loss until I decided I sold this protection leg for profit. I say profit and I put them in quotes because when I opened the trade, they cost me 20 cents and then they turned into like $4. In this case, I don't know what the original entry price, but I'm going to guess it was less than this. And now because price has fallen so far, this would be considered a profit on that particular leg. So what happens then? So if I sell this, that money goes into my account. I made a good trade on that one leg, if I want to separate the two just to illustrate the point. But now I kept my risk open. That's the danger part because that's the one I sold. And this is where I said to somebody, I will buy your shares at $32.50. So that's an immediate $7 loss. Where is it now? Anyway, wherever it is now, minus $32.50. So I'm already wrong in the stock. First of all, I don't mind if I want to own it a super long term. I can sell calls against it. But what is different here that I do have a price buffer now because this position will disappear if they assign me shares. So if I sold one put, I probably have $600 in losses because I probably collected $2 and now it's worth $8.50. But those paper losses will disappear. In return, I would have 100 shares at $32.50. But I just collected $4 from $3.50 from this, so my break-even point just dropped because yes, I'm in at $32.50, but I've just collected some money from this, plus the money I collected to open the whole trade to begin with. That was a credit too. So that goes to the break-even point. So now I'm not that, okay, so now I'm lower for the break-even point. So this is where what do I want comes in as to what I do next. So personally, what I can do, for example, if I don't want the shares right now, I would sell this and move this. So how can I move it? I'll buy it from here, but I'll sell it somewhere else out in time. And if I love the shares and I want to own them for a long time, I can sell it at 26 for $100 cost. Remember, I have $3 or $4 to play with. So I don't have to sell it for $8. The break-even point would be $8 minus all the credits that I collected. So anywhere here would break me even. And then that means I'm long the stock exactly where it is right now. So let me repeat this. This is the current situation. If I'm stuck in this, and if I collected $1 and now it's $5, so I lost $4 for contract. If I did one contract, that's $400. In this case, I can accept the loss and move on. If I want the shares, and this particular person wants the shares, but how about we get lower than 32.5? Then I would sell this for a profit. So I collected $1 to open. I'm collecting another $3.65 here, so that's $4.65. And now I'm still stuck with a loss here. And what I can do with this one is I can buy it back to take off the risk and sell it out in time. I'm, quote, rolling it out in time. What did I pick? June? So I went to June. I can pick May. I can pick January. And if I sell it here, that would be eyeball break-even point for me on this particular transaction, all said and done. And this is where current price is, I think. For $24.01 right now, I just looked. So I'd be in at 24 versus them sticking me the stock at 32. If I don't mind owning it at 32, then I would just take the stock and start selling covered calls in it. So rolling means closing the loss and opening it somewhere else in order to try to salvage the trade. Few rules that I have. I do not increase the size of the risk. So if I did one contract, I'm not going to do two contracts to, quote, make up the difference. Because if I had, this is a problem trade, I just made it bigger by increasing contracts. I don't do that. If I'm not willing to own the shares, I shouldn't leave myself naked a put. Be short naked put. So I shouldn't close this and leave this if I'm not willing to own the shares. I did it with my particular situation. It was US Steel. Because I was okay owning the shares, it was a calculated risk on my part. I didn't really want to own the shares, but I lowered my break-even point by doing exactly what I'm saying here. I was short the $9 put and long the $8 put, and then price went to $4.40, $4.50 last year. And they didn't give me the shares, so I sold my protection leg, collected a whole bunch of money, thereby lowering my break-even point from 9 to somewhere around the 4s, maybe 5. I can't remember. But then the stock started migrating higher and higher, and they still didn't give me the shares. And then finally, when it came close to my price, I just bought back the put I originally sold for about 20 cents more than I paid when I collected. But it was a profitable trade because I benefited a lot from my protection. So in this case, similar scenario. They're stuck in a credit put spread. It's completely lost. A spike would save it, but it's highly unlikely with 3 days left. So I could sell this and accept the shares at $32.50 and put them to work if it's a long-term investment. I could sell this and move this somewhere else. So or move the whole thing somewhere else. Similar situation. So how does that happen? I close them here, and I would add 2 legs somewhere else. So I would, what would we pick? June. So if I think that June would be time enough for the stock to recover, then I would open a similar position somewhere in June. I'm having a hard time focusing here, folks. Bear with me. So they don't have the same legs, so I'll have to do something similar. This was $5 wide. So what did I pick? 32.27, $5 wide. So something's wrong here. What we see here? Oh, I'm selling both. Okay, so the rolling position would be like this. Okay, so rolling it would mean closing it here. See how it turned green red, and opening it in June. Watch. At 32. So in this case, I have to pay $1. But remember, I collected $1 to open it. So this is basically buying myself 3 months for it to get back above that. That's not my preference. Okay, I don't like that as much as the other situation where I did the selling the protection leg and moving the short leg if I don't want the shares. That would be my preference in this case. There are similar situations in Apple, and it depends on where the sold leg is. Like if I sold the leg in Apple at 117, I'm okay with it there, taking shares there. If it's at 125, I would probably move it down and out. There's protection, there's support at 112, 108, and 103. Those three should really be really good supports for Apple. Just using another example. Tesla, I bet you there's a lot of them there. I have a credit put spread in trouble with Tesla, and what I would do in mine is I would roll it down and out. If somebody is really buried in Tesla and they have the money in their account to take naked puts, I could roll it. Like if my problem was in the 670s, and it's a 670, 680 credit put spread that's now like $8 or $6 or $7 to close, and I only collected $1, so it's really underwater, I would take it out. And if I love Tesla, I want to own it. This is my punt. Okay, this is where I say, you know what? I just don't want to deal with it for a long time. I would go to September or July and go to, what's going on with my mouse? 400, even, yeah, 350. Look, they paid, one contract is $23. So either move it down here or as a spread and just pay the difference, or just sell the naked to own shares. I never sell naked put unless I want to own shares. And if I don't want to own it at 400, I can own it at 300. These premiums are very hot. And if I believe in it long term, I can go to next January and go even lower to the 200s. So this is where I've got a problem, and if it's a big pile of money, I got to save it somehow without being reckless. I just punt it way down and way out. I don't do this often because if the markets crash, we don't know what's going to happen. Then that creates even bigger problems. So if I have one particular situation and I do like the stock and I would definitely own it at 280, and that's a definite yes for me on the 280 part, then I could punt it down here. All right, these are just crazy ideas on how to handle them because these are crazy markets. The Palantir situation is not that crazy. It's a realistic thing. Nothing here is a recommendation because every person is different how they handle. What is this? That's today. So somebody's probably doing what I just said to do. Okay, so this is interesting. For next January, there's been an exchange of 633 contracts at 300. And this is the amount of money that exchange hands. That's a lot of money. So somebody's making a bearish bet, somebody's making a bullish bet. We don't know the buyer or the seller, so we can't say they are buying or they are selling. They are exchanging. They don't buy them off the shelves. All right, Nick signing out.